So first thing we're going to do is go over the assignment that you did for Monday night. That was number 20, the cash receipts and disbursements with credit sales. You did a good job with that. And then I'm gonna show you how to do it if it's a credit card. And then you'll have an assignment due, graded assignment due tonight with the credit card one. And that's what we'll go over on Friday. And then your final is next week on Wednesday, right, at 7:30 a.m. And I will, as I told you the other day, I'll open it at 7. So you'll have 2.5 hours. You will have 2 pieces. You're going to have to do 2 cash budgets. So you should have plenty of time. All right, so let me get going here. Okay, so this was number 20. And again, cash budgets are all about how well you follow directions. With the kind that we're doing with this one, credit sales were account receivable type sales. So we don't care when we make those sales, we care when they convert those sales to cash. Some of the sales for this particular one were cash, and they broke it out. It was set up a little bit differently. And that they gave us our cash sales and they gave us our credit sales. So our credit sales were this top line, and then I just stuck the cash ones down here. Because again, it's not when they make these credit sales, it's when those credit sales convert to cash. And so the way this one was that we collected 60% of those in the month after. And so again, it's all about the diagonal. So you would go to September. In September, we're going to collect 60% of August. And that's going to go across, maybe. And then we're going to collect 40% 2 months later. So again, we would take August sales, and now we're going to collect 40%. And so again, it's the diagonal, add them up to make sure you got everything. So those two should add up to that, and they do. We're only doing this for October, November, December. So you don't need to fill these in, even though we had information. But we needed August sales because part of August sales were collected in October. And we're doing this for October, November, December. Purchases were 35% of total revenue. So I'm going to go down here. And again, I'm just going to do this. Okay, I'm just checking something here. We're going to just add up our sales. So I'm going to add the credit sales for the month plus the cash sales for the month, just to get my total sales. And then the food cost was based on that total revenue. So we're going to take these and we're going to multiply by 35%. That's when they buy. Okay, so that's when they buy, but I don't care when they buy, I care when they pay. And so actually I need to put September in here too, because September is paid for. Okay, so then I'm going to draw a line under this so that I make sure I don't add it in my totals, because they're paid for the next month. Again, I don't care when they buy it. I care when they pay for it. And so the stuff I bought in September will be paid for in October. October's in November, November in December. Now December, we talked about this a little bit the other day. If you were doing pro forma financial statements, this amount right here would be your accounts payable, because that's what you still owe. Up here, our accounts receivable would be what we still haven't collected. Okay, so we're gonna go to the next one. See what else I got here. Payroll. So with payroll, we're just gonna put it in. Okay. Then they give us other budgeted expenses. So it tells us which ones are paid each month. So rent is paid every month. And energy costs are paid every month. Okay. What else we got? Loan interest. So we had interest of $400 every month. And then let's see what else I got. Other expenses. Excuse me. 1,200. Okay. Insurance is paid in November each month for the entire year. So we got to put in our insurance only when it's paid. Remember that $200 a month for insurance is your adjusting entry, like we did at the very beginning of the semester. Okay, like we did at the very beginning of the semester. Okay, so we've got everything. We don't have a mortgage payment, so let me just take that out of there. Okay, undo, I'll read further. Okay, so in the next paragraph, it's telling us that we're making principal payments every month on our mortgage. So I'll put that in. And equipment's going to be purchased in November. It's going to cost $6,600. But we're going to sell some old. The gain is $800 and it has a book value of $1,200. So this one, a few of you made a mistake here. Remember, it's cash received. So the gain is on top of the book value. So you would have the $1,200 plus the $800 gain. So this up here should be $2,000. Okay, it's the book value plus the gain. And then they want to give a Christmas bonus in December, 5,000. All right, so then we just add them up. So actually, we're only going to add from here. Make sure you don't include that top line. Okay, and we're going to come down here and add these up. Change in cash, remember, is receipts minus disbursements. And then our beginning cash, they tell us, is 3,000. So we're going to add those two together to get our ending cash. Ending cash for October becomes beginning cash for November. And so we end up with 10,828. All right, questions on that? Say most of you did a really good job. Some of it was just adding errors, and this thing right here caught a couple of you. Okay, then I'm going to go on to the next one. So we're going to do number 16. And the difference between 20 and 16 is that 16 is a credit card. Okay, credit card. So we're going to start out. This is number 16. And we're only actually doing this for January and February. So we have information from December, January, and February. All right, so the first thing that they tell us is what our sales are. And so our sales are okay. So those are our total sales. Now, in this case, they're 40% cash and 60% credit card. We still have to divide them. So with this one, I'm going to put my cash first, which is 40%. And then I'm going to do my credit card, which is 60%. And so I'm just going to divvy them up just like we always did. Okay. I'm going to draw a line under here because I don't want to add this number in. Now, with a credit card, the store has to pay a fee. And it's always a percentage of the credit card sale. And these vary, it just depends on what kind of an agreement you have with the credit card company. But that's going to be subtracted off what you're actually going to get in sales revenue. And I noticed that some companies now are charging an extra 3% if you use a credit card, because they're charging you their fee. So we're going to take just the credit card and we're going to multiply by 2%. And I'm actually going to put a minus sign in here because I want it to subtract. So that's the credit card fee on those credit card sales. And that right there is the entire difference between the problems that you just did and this one. It's all about how you split up the sales. Everything else is going to be the same. So we'll just continue on with the rest of the problem. Everything else is going to be the same. But credit card money comes in the month, but you have to take off the fee.
Why is it a reduction in sales and not just a disbursement as a fee that you pay like you would interest?
For me, it's all about the net sale.
Okay.
And I think too, doing it this way, you make less mistakes because carrying it down below, sometimes you pick up the wrong number.
And is this the GAAP approved way that you would see on a statement? I seem to remember seeing credit card commissions as a separate line item having nothing to do with. So maybe it's just, I'm thinking more, P&Ls and detailed statements as opposed to cash budgeting that we're doing here. So
I don't know. I've always taught it this way. I'm just trying to see why I've always taught it this way.
Okay.
I just trying to look back on the book. I mean, it's not wrong to put it down below. I certainly would not mark it off. I've always just done it this way to show the net sales.
Okay. I mean, it makes sense what you're saying. I'm just, so many other things are based upon total sales, and with credit card commissions being such a huge amount in bigger businesses, it could impact.
Except that you would base everything on this number. The total sales.
Yeah.
I say I don't really care if you want to put it down on the bottom. It's fine with me.
Okay.
And then I shut my book, which wasn't too smart. All right, so other expected income is interest that's supposed to be received in February. In addition, a range with a book value of 300 is expected to be sold for cash, resulting in a gain of $1,000 on the sale. Okay, so we need to record total cash received, which is the 300 plus the gain. Okay, make sure that was the one kind of error that we had in the homework. Just it's all about cash received. All right, so food and beverage are paid for following the sale, the month following a sale, an average 40% and 25%. So this is another one where we'd have to split our sales. So we gotta split our, oh, hang on a second, something in my eye. Okay. All right, food sales are 4 times beverage sales. So this is like that one that we did the other day. So we have food is 4/5 and beverage is, did I get that right? Beverage is 1/5. So we have to split our sales into food sales and beverage sales because their food costs and the beverage costs are 2 different percentages. So basically our sales are 5 parts. And so we're gonna take our sales down here. I'm gonna bring, you don't have to put all this down here, but I wanna put it down here so that you can see. All right, maybe what I'll do is I'll do it over here. So we're gonna take our sales. Okay, so I'm going to divide it by 5. So 1/5 of it, or 20%, would be beverage. And then food would be 4/5. So times 0.8. And so that splits our sales. Oh, that's not working. Okay. So then based on that, we're going to do our purchases. So what I'm going to do is I'm going to copy this down over here. So that I can figure out what my purchases are going to be. So I'll draw a line here. All right, so purchases are They're paid for the month following the sale. So first of all, we got to figure out what they are. So food is 40% and beverage is 25%. Okay. So for food, we're going to take our food sales, which are these, and we're going to multiply by 0.4. We're going to take our beverage sales, which are these, and we're going to multiply by 0.25. So those are our purchases. I'm going to draw a line under those again. And so purchases are paid the next month. Okay. And so in January, we would be paying for that. And we would be paying for that. Okay, so it's a long roundabout way to get to your purchases. All right, so this is like the one that we did. Oh, we did one of these in class one day where we had to split the sales and just figure out the parts. Beverage is usually one part, and then food is usually so many times that part. And so basically what you have is 5 parts. And then you can just divvy them up and then calculate your purchases. And then we're going to pay for them the next month. Is there any questions on all this piece right here? Everybody see how it's being split? And why? Okay. All right, let's keep going then. Labor's paid the last day of the month and averages 35% of sales. Just be careful with these to make sure that you're going back and getting your total sale numbers. So it's going to be the total January sales. Other expenses are $20,000 a month. January, 30,000 is expected to be sent on new equipment. Funding for that is coming in part from a loan, and make sure you do this way. Do not net them out. You're going to get the same ending answer, but you're presenting a not correct view of the company. Because they actually purchased $30,000 worth of equipment and they now have a loan. And that's it. Okay, so that's total. First one never comes on there. Again, make sure you don't go above the line. And then down here, again, don't go above the line. Gonna do our change in cash, which will be your receipts minus your disbursements. Our beginning cash, they told us. Gives us our ending cash. Ending cash for January becomes beginning cash for February. There we go. All right, questions. So the difference between credit card, so credit card, you're going to split cash and credit card because you only want to pay the brokerage fee on the credit card. You don't want to pay a fee on your cash. And I don't care if you want to put this down under credit card commissions, that's fine. But just make sure when you calculate it, you only calculate it on the credit card sales. Credit card sales. Everything else is the same. Back here, where we split it, this one was set a little differently because they had already split it for us. So we had our cash sales that go in the month. We had our credit sales, and we had to split to has when they become cash. And remember, it's all about the diagonal. If you find yourself doing stuff down in the column, you're doing it wrong. Do it across, do it row by row, and I think you'll make less mistakes. Questions? Okay, your assignment for tonight, and it's your graded assignment, is number 15. It is a credit card. We'll go over that on Friday. And any questions that you have your executive conclusion is due on Sunday night. And other than that, you have your test next week. Questions? All right, we're gonna get out early today. So go enjoy the rainy, yucky day.
Have a good day.
You too.
Have a good day.